Welcome to Real Estate and Taxes with Lakshay. I will be helping you minimize your taxes. My name is Lakshay. Welcome back to my Tuesday session on Real Estate and Taxes. Today we're going to be talking about how we can take money out of our PREC in form of a salary or a dividend. A lot of you might have been wondering, once you have incorporated, how do you take money out of your PREC? There are two forms that you can do it in. You can either pay yourself a dividend or you can pay yourself a salary. So today we're going to shed some light as to what option is the best when it comes to withdrawing money from your own corporation. Once again, welcome. We meet every Tuesday on Real Estate and Taxes, and today's topic is how to pay yourself from your personal real estate corporation. So if you have an owner-managed business, whether it be an accountant, whether it be a doctor, whether it be a realtor, most of you already know there are benefits to incorporation. When you incorporate, you get to enjoy lower taxes on the first $500,000 of income, which is 12.2%. So in this scenario, let's assume I'm an accountant. I have to pay myself a salary or a dividend when it comes to withdrawing money from the corporation. So which is the best option? Should I be paying myself entirely a salary? Should I be paying myself a dividend? Or should I be paying a mix of both? So today's topic, we're gonna hopefully address it with a few examples, numerical as well as qualitative examples in order to determine which option might be best for you. So if you're an owner-managed business, you have two options, salary or dividend. And today's topic, we're gonna talk about three examples. Example one would include no salary or dividend. Number two is $25,000 salary. And number three is $25,000 dividend. If you are incorporated, you must be earning some income and you must have a bunch of expenses which you are technically paying out of your PREC. And after you earn income, you pay all of the expenses, whatever is the net income inside the corporation, you pay 12.2% taxes. And after paying the 12.2% taxes, you will be left with after cash profit or after tax cash in the corporation. So let's look at an example. In this example where you're paying zero salary or dividend, what you're trying to do is your income was $100,000. After meals and entertainment, insurance, and various other expenses, your total expenses were $11,000. So what are you left with? 100 minus 11,000, you're left with $89,000 of net income in your corporation. Now you must be wondering, what are the tax implications on this net income? $89,000 inside the corporation is taxed at 12.2%. So $10,000 would be your tax liability. And now 89 minus 10,000 would work out to roughly $78,000 of net income. This kind of gives you a good idea that if you were paying zero salary, zero dividend, what are your tax implications and what is the after-tax cash flow left inside the corporation. Now let's look at an example where you're paying a $25,000 salary to yourself. With the same level of income of $100,000, it's the same level of expenses with the only exception that we're paying ourselves a salary, you get that as part of your expenses. So now your total expenses has become $37,000. That means your net income is lower and your tax liability is lower. So technically you have after-tax cash left of $54,000, and in your tax liability option, you are paying $7,600 when it comes to the corporation. Now let's look at the third option. The third option is you're paying yourself a dividend of $25,000, but the salary is still zero. If you notice in this option, it is pretty much same as the option where there was zero salary and dividend. So the idea is dividend is actually not part of your expenses. They are paid out after it's a balance sheet item. They are paid outside of the income statement. So they're not part of your expenses. So when you pay a dividend, your tax liability doesn't decrease. Whereas when you were paying a salary, your tax liability went down. So this is a key factor which we're gonna further explore in the following slides. From the tax perspective, there are two things we need to consider. Number one is business owners' personal taxes based on personal tax slabs, and number two is corporate taxes. So we're going to look at both personal side as well as business side. What are the tax implications? If you are a business owner and you withdraw a $25,000 salary for yourself, what is your tax implication? Your total tax liability would work out to $3,065. $25,000 minus federal income, minus provincial taxes, minus CPP, and then basically you're left with after tax income of roughly $21,935. So that works out to average tax rate of 5.82 and marginal tax is 20, which is the lowest tax bracket. Now let's look at a salary where you're paying more than $25,000. As you pay more salary to yourself, you're in a higher tax bracket. Similarly, your taxes becomes higher, which is $7,200, whereas in the $25,000 salary, you are only paying $3,000. Your after-tax income is 40 minus $7,200, which is $32,790. The tax rate is marginal tax rate is pretty much the same bracket, like 0 to 45. It's the same tax bracket. That's why this is still 20.05. Now let's look at it from a perspective that if you were withdrawing a dividend in salary, you notice the tax liability was $3,000 under this 25,000 and $7,200 under 40,000. Now what happens if you were to withdraw a dividend? Under the dividend scenario, you are able to save a lot of money because 25,000 of dividend only results in $300 of taxes. And under $40,000 of dividend only results in $600 of personal taxes. So quite a difference between dividend and salary, because dividend, there is no CPP component, there is no EI component, and there's no income taxes. Income tax is there, but it's a very low amount. So if you notice apples to apple, dividend is looking like it is the cheaper option, and you get the most benefit. Now let's look at the situation from the corporation's perspective. Previously, in the two slides, we talked about how would the salary, if Lakshay was to withdraw from his own corporation, how would the Lakshay be paying per taxes personally? So as the salary went up, the tax portion went up. When he withdrew the dividend, the tax portion was very little, very minimal, because there was no CPP, there's no EI. If we look at it from the perspective of corporation, if Lakshay's accounting firm, how would salary reduce the taxes, or how would the salary impact Lakshay's business income? Under the business income perspective, like I mentioned, I will have accounting income, I have expenses, meal and entertainment, insurance, and different types of telephone, fuel costs. So net income would be taxed at 12.2%. So in this scenario, I withdrew zero salary, zero dividend. I'm left with $10,000 of tax liability. If I look at a $25,000 salary, $100,000 of income, all of these expenses added works out to 37. So 100 minus 37 works out to 62,000. And on 62,000 times 12.2% works out to 7,600 of tax liability. So from a corporation perspective, my company will be liable to pay $7,600 in taxes. Now let's look at from the dividend perspective. If corporation was to pay Lakshay, Lakshay's accounting firm is paying Lakshay a dividend, how would it work? Under the dividend scenario, it would not be part of the expenses because dividend is not considered an expense. So technically what you're doing is you're taking $100,000 of salary, subtracting all of the expenses, and then net income works out to 89,000. On 89,000, you have a tax liability of 10,800 and you have an after-tax cash flow of 78,142. So from this perspective, the after-tax cash flow is much better in the dividend option, but I'm not able to reduce the tax liability in this scenario. So what would be the best scenario? Is it a mix? Is it something that we need to consider from a different angle? Let's compare both of them on the same slide. Under the both scenario, under salary and dividend, if we compare apples to apples, under the salary perspective, the corporation will be issuing a T4. And if you are taking a dividend, you would have to issue a T5. From the expense section, you have income statement. You would have to report the salary, so it reduces your net income, and it basically makes it better for you to withdraw a salary because if the net income is lower, your taxes are lower. From the dividend perspective, it comes from after tax dollars. That means there is no expense on the income statement. From the salary perspective, the only disadvantage is you have to pay CPP, EI, and income taxes on a month-to-month basis. So let's assume if I was a salaried employee of my own corporation, which I am, I need to pay the source deduction, which is CPP, EI, on every salary check on a month-to-month basis to CRA. When it comes to dividend, there is no such requirement. So if I have 5 employees, I basically have let's assume I'm paying them $15,000 a month. I would pay them $12,000 and change, and the difference between $12,000 and change and $15,000, I need to pay that to the government on a month-to-month basis, which is a little bit cumbersome. You definitely need an accounting software to maintain their vacation pay, their CPPs, and their EIs. Whereas in dividend option, there is no such thing. In dividend, you simply write a check as a business owner to yourself saying dividend for quarter 3 and the amount. So it is as simple as that. Like I mentioned, the monthly remittances has to be done by the 15th of every month if you're withdrawing a salary. So the compliance is definitely higher. Whereas under dividend, there is no CPP to deduct, there's no EI to deduct. So you simply just write a check. So compliance is actually also very low. Does salary work better for someone who's going for a house, or dividend work better for someone who's going to be buying a house? Personal opinion is salary works better because when you're going to the bank, dividend is not a comfort that they are happy with when they see it on their bank statement. Dividends are not cyclical. They're not paid monthly. They're paid once a year. So when you go for financing, salary works far better because you are able to show it on your bank statement that you're getting monthly paychecks, and comfort level of the bank is much higher that you are a salaried individual. So from that perspective also, I would highly recommend, salary is a better option. Under the dividend, because it's not cyclical, because it's not being paid monthly, the comfort level of the bank and other financial or lending institutions is not 100% as it would be for a salaried individual. What happens to the childcare and the RSP contribution room? If you're paying a salary, we all know that 18% of your prior year salary brings your contribution up for the RSP. This is not the case with the dividend. So salary impacts your RSP room, meaning that if you are not paying yourself a salary, your RSP room will be lower. If you pay yourself a salary in prior year, your contribution room will be higher. So it is very important to consider these factors as well when you are deciding, do I want to go for dividend? Do I want to go for salary? I might be getting a car. Maybe the lending institution might want to see a salary monthly. So salary might be a better option. Under the dividend option, this is more like once a year, but it basically has no impact on your RSP. For RSP purposes, you need to have earned income or salaried income in order to increase your RSP room month over month. If we look at the total overall impact on childcare benefits, your childcare benefits is based on your family's annual income. So your annual income for salary really impacts your childcare benefits, whereas dividends does not have the same impact that a salary would have. So these are some of the qualitative factors that needs to be considered in order to identify, should I go for salary or should I go for dividend? We talked about 2 perspectives here. There was, should we be paying it under 100% as salary, or should we be paying it under 100% as dividend? From the mathematical assumption or mathematical cases, I was able to determine that the only difference between paying yourself a dividend or a salary was the CPP. Because when you're paying yourself a dividend, there is no CPP. It almost looks like a cheaper option. It looks like the better option. But when you look at it from the qualitative perspective, where you have to go for financing, where you have to create an RSP contribution group, where you have to, look at your childcare benefits, then salary works out to be the better option. So my final decision would technically be based on your overall personal finances. Personally speaking, people take a mix of both. They take $45,000 salary and then pay CPP and EI on that, and then the remainder, maybe $30,000 more, they would take it as dividend because there's no CPP and EI component. So from that perspective, on a month-to-month basis, when you take a lower salary, your month-to-month commitment is also lower, so it works out better in that sense. Also, salary allows you to get qualified for mortgages and create RSP rooms. Dividend is more for someone who wants to keep money in the corporation and reinvest it year by year basis. So both options, I think, we went in a lot of depth, and I hope, this kind of gives you some light as to whenever you are making your personal decision, should I be withdrawing a salary or should I be withdrawing a dividend? Here's my contact information. Thank you once again for joining our Tuesday session on real estate and taxes. We'll be back with another one next Tuesday at 2 p.m. So feel free to join us there.